Most people think freedom begins when they quit their job. They are wrong. Freedom begins much earlier than that. It begins the day your life stops depending on one source of income that disappears the moment you stop showing up. That is the real line. A salary looks safe because it arrives on schedule. It shows up every 2 weeks. It is clean. It is familiar. It trains you to believe that predictability is the same as security. It is not. A paycheck is one stream. If the employer changes its mind, if the economy turns, if your health changes, if the department is cut, if the company decides you are too expensive, the stream stops. You can be hardworking, disciplined, experienced, even admired inside the company, and still discover that your financial life was built on something far more fragile than you realized. That is why I do not frame this conversation as how to get rich. I frame it differently. How do you replace dependency with a machine? Because that is what a real financial life becomes when you build it properly. It becomes a machine. One part sends out interest. Another sends out distributions. Another sends out rent. Another sends out business profits. Another sends out returns from capital you have already put to work. Piece by piece, the machine learns to do what your labor used to do alone. That is the mother line of this entire conversation. You are not trying to find one magical asset that pays you enough to never work again. You are trying to build a private paycheck system that does not collapse just because one source fails. Once you understand that, the conversation changes completely. Most people begin in the wrong place. They say, I make $80,000 a year, so I need one investment that will produce $80,000 a year. That is not how serious wealth is usually built. Serious wealth is built in layers with different forms of cash flow doing different jobs inside the system. Some cash flow is there for stability. Some is there for growth. Some is there for tax efficiency. Some is there for inflation protection. Some is there because it compounds quietly. Some is there because it can scale. Some is there because it gives you optionality when the rest of the machine is under stress. That is how adults think about replacing a paycheck. Not with fantasy, with architecture. The first layer is what I call base income. Base income is boring money. I like boring money. Boring money is underrated because boring money calms the system. It gives the machine a floor. Treasury income sits in that category. When you lend to the United States government, you are not buying excitement. You are buying a stream, a yield, a sequence of payments attached to the strongest dollar-based obligation in the world. That does not make it perfect. It does make it useful. The beauty of Treasury-style income is not that it makes you rich quickly. It does not. The beauty is that it creates a baseline of cash flow with a relatively low level of business drama. No management scandal, no tenant calling at midnight, no dividend cut because a CEO got ambitious. It is money with fewer emotional surprises that matters more than people think. A lot of people ruin perfectly good financial plans because the whole plan is built on assets that are too emotional to hold. They need a machine they can actually live with. Stable interest income does part of that work. It will not usually give you great principal growth. It will not usually turn a small account into a fortune by itself, but it can become a stabilizer. And stabilizers are what allow the more aggressive parts of the machine to keep working. That is a very important role. The second layer is what I call equity income. This is where most people begin to understand the difference between owning labor and owning capital. When you own a strong dividend-producing company, or more practically for most people, a strong dividend-producing basket of companies, you are taking a small step into a better world. You stop relying purely on wages and start participating in profit distribution. That is a huge identity shift. The average employee thinks, how much will I get paid for my time? The owner asks, how much cash will this productive asset send back to me while I sleep? Those are two different species of thinking. Dividend, paying equity, is not as simple as many people pretend. A high yield by itself proves almost nothing. In fact, a high yield can be a warning sign if the underlying business is weak, over-leveraged, shrinking, or desperate. The crowd loves yield because yield feels like immediate relief. I care much more about the engine under the yield. A mediocre asset with an attractive payout is still a mediocre asset. You do not want income that comes from decay. You want income that comes from productive strength. That is why broad dividend funds can be so useful. They reduce single company risk. They remove some of the homework. They turn your personal process from constant stock babysitting into a quieter ownership model. No, they are not magical. They can fall in price. Dividends can change. Markets can punish them. But they give you a broader claim on real corporate cash flow. And for many people, that is the first serious step away from total paycheck dependence. The third layer is what I call real asset income. This is where things get more powerful and more difficult at the same time. Real estate appeals to people for a reason. When you own a productive property, you own something visible, durable, and functional. A tenant pays you to use it. The cash flow can come monthly. The debt can be amortized over time. The rents can rise. The underlying asset can appreciate. The tax code, in many cases, treats real estate owners with extraordinary generosity compared with wage earners. That combination is why so many fortunes have been built there. But real estate also teaches a brutal lesson. A paycheck replacement machine is not the same thing as a passive fantasy. A rental property can behave like an income engine only if the numbers are real. Too many people buy a property and call it an investment just because they hope the neighborhood will get hotter later. That is speculation wearing work boots. I want a property to act like a machine. That means the rents must do real work. They must pay taxes, insurance, management, maintenance, vacancy, friction, financing if financing exists, and still leave a surplus that justifies the capital and the hassle. If the machine does not produce after all that, then it is not a paycheck replacement asset. It is a hope asset. Hope is not cash flow. This is why real estate humbles lazy people. It rewards discipline, patience, and deep familiarity with numbers. If you are willing to do that work, it can become one of the strongest layers in the entire system because it offers three things at once: cash flow, asset ownership, and tax leverage. Very few assets do all three. That does not mean everybody should run into real estate tomorrow. It means people should stop treating it like a slogan and start treating it like a business, because that is what it is. The fourth layer is what I call profit ownership. And this is where the game changes most dramatically. Interest is one form of income. Dividends are another. Rent is another. But profit ownership is different because it is the most elastic. If you own a business or a meaningful piece of a business, you are no longer just collecting what capital is owed. You are collecting what remains after the system produces more than it spends. That residual is where wealth accelerates. The employee gets paid first in a narrow band. The owner gets paid last, but with upside. That upside is why businesses can become such extraordinary paycheck replacement engines. The right business can outgrow wages, outgrow inflation, outgrow bond yields, outgrow many real estate returns, and create optionality far beyond what a static portfolio can do. But the price of that upside is difficulty. A lot of people love the sentence, buy a business. Much fewer people enjoy the reality. Let's put us as not a dividend check with a smile. A business is a living organism that can die, stall, misfire, disappoint, or flourish depending on leadership, systems, competition, economics, incentives, and sheer execution. If you buy wrong, you do not get passive income. You inherit a problem disguised as an opportunity. That is why I am so careful here. Business ownership is not merely an asset class. It is a character test for the right person. It can be transformational. You can work inside the machine first, learn how it breathes, then gradually build a version that functions with less and less of your personal labor. Eventually, if you are excellent, you are no longer replacing your paycheck with a distribution. You are replacing it with a profit engine. That is the closest thing to real freedom capitalism offers, but it is earned, not granted. The fifth layer is what I call asymmetric lending. This is the least romantic layer, and that is precisely why some people underestimate it. Private credit peer-to-peer lending, hard money lending, collateral-based lending, whatever form it takes, the principle is simple. Your capital becomes somebody else's fuel, and you are paid for the risk and inconvenience of supplying it. In theory, this is straightforward. In practice, the details are everything. The first question is always the same. What happens if they do not pay? That single question separates intelligent lending from amateur disaster. Too many people hear a double-digit interest rate and start acting like they found a cheat code. They did not. High interest is often the market's way of telling you that the risk is real and should not be ignored. If you are going to lend privately, you want to understand collateral, seniority, legal enforceability, recovery process, time horizon, and borrower quality. Otherwise, you are not creating income. You are manufacturing future stress. But done properly, this layer can be powerful because it creates another stream that does not depend on your employer, and it can be structured in ways that suit your own appetite for risk. The important thing is not the headline yield. The important thing is whether the structure protects you when the easy assumptions break. That is always the real work. Now, if you step back, you can see what I am really describing. Not 5 random assets, 5 functions inside a private income system. Treasuries stabilize dividend equity, distributes corporate cash flow. Real estate adds tangible yield and tax advantages. Business ownership creates elastic profit. Private credit monetizes capital directly. Each one does something different. This is what average financial advice misses. It gives people one generic answer because generic answers are easier to sell. Buy the index, wait 30 years. Hope the future resembles the spreadsheet. There is nothing wrong with broad index ownership for building wealth. I own productive public equities myself. But there is a difference between building net worth and replacing a paycheck. A paycheck is not only wealth, it is monthly utility. That is why someone can have a large portfolio and still feel trapped. The portfolio is rich in theoretical value but poor in usable cash flow. So they keep working, not because they are irrational, but because the machine was never designed to send enough money out. That is the trap. A lot of people spend decades accumulating assets and almost no time studying distribution architecture. Then they reach middle age or later and discover that they built a beautiful balance sheet but a weak personal economy. That is a painful realization. So if you ask me how someone should think about buying assets to replace a paycheck, I would say this. First, stop fantasizing about speed. Any real machine takes time to build. It takes sacrifice, surplus, discipline, and patience. The person who wants to replace employment income in 6 months is usually looking for an illusion. Second, think in layers, not in single bets. One layer for stability, one for corporate cash flow, one for hard assets, one for scalable profit, one for lending opportunities if your skill set and risk tolerance justify it. Third, respect quality more than headline yield. A weak asset with an attractive payout is often just a slow motion disappointment. The machine must be built from engines that can survive, not just from numbers that look good on a thumbnail. Fourth, remember that taxes matter. The amount you keep is what funds freedom. Many people focus only on gross income and ignore structure. That is one reason wage earners so often feel trapped. The system taxes labor harder than it rewards ownership. The sooner you understand that, the more intelligently you will allocate capital. Fifth, accept that the right structure depends on your temperament. Some people should never own rentals because they hate operational complexity. Some people should never buy a business because uncertainty breaks their sleep. Some people should never touch private lending because they do not know how to assess downside. It is better to build a machine you can actually operate than to copy someone else's glamorous one and destroy yourself in the process. And finally, understand the identity change underneath all of this. The worker says, "I need a raise." The owner says, "I need another stream." That one sentence can change a life, because once you begin looking at your financial life as a set of streams instead of a single salary, everything becomes clearer. You stop asking whether one job can save you. You start asking how many independent flows can eventually make the job optional. That is the right question. If you build enough intelligent streams, work stops being a survival requirement and becomes a choice. Maybe you still work, maybe you work less. Maybe you shift to work you actually enjoy, maybe you step away entirely. That part is personal. What matters is that the machine can now carry more of your life than your labor alone. That is real leverage. And I want to end with one final distinction because it matters tremendously. Never working again and never needing to work again are not the same sentence. The first is fantasy bait. The second is financial freedom. I am interested in the second. And if you build carefully enough, buy intelligently enough, and let enough streams mature long enough, you do not need a miracle to get there. You need architecture, you need time, you need discipline, and you need the courage to stop thinking like an employee every time you make a decision with money. Because the moment your capital starts working harder than your labor, the future stops looking like an endless series of pay periods and starts looking like something much more powerful, a machine. One you built yourself, one that keeps paying even when you are not in the room.